How's it going, everyone? My name is Dan, but you can call me Malone, and unless you've been living under a rock for the past few weeks, you've no doubt heard lots of talk about inflation. UK inflation hits 10-year high. Eurozone inflation confirmed at 4.1% on energy spike. US inflation hits highest level since 1990 at 6.2%. Clearly, there's lots of talk, uncertainty, and worry about what effect this inflation will have on the likes of me and you, both in the short term and the long term. There's also much debate over how long we can expect these high levels of inflation to last, with many economists, along with the US Federal Reserve, expecting it to be temporary. But what does any of this mean for you, and should you even care about what's happening? We're going to break it all down in this video in plain English, but before we do, if you're happy and you know it, click the like button. And if you are new around here, please do consider subscribing to the channel. It would be great to have you back again on future videos. With that out of the way, let's talk about inflation. If the word inflation is new to you, or you can't quite wrap your head around what exactly it is, let me try and help you out. When we talk about inflation, we're talking about an increase in the price of goods and services in the economy. Things like cars, petrol, clothes, and even meat start to become more expensive due to rising prices. However, not all inflation is bad. In fact, the European Central Bank aims for an inflation rate of around 2% each year, and they define this as being a stable level. But too much inflation can cause big issues for an economy. The most classic example is Germany in 1923, where the inflation got so bad that people had to physically carry their money around in wheelbarrows. This happened because the German government were printing money to pay the wages of striking industrial workers. As more money continued to be printed, prices skyrocketed, and the value of the German currency was driven into the ground. You see, inflation reduces the purchasing power of your cash, meaning that the cash you have sitting in your bank account has less of an ability to buy goods and services as compared to, say, this time last year. The inflation we're seeing today is nowhere near as serious as 1923 Germany, but it's still significant and it does have an impact. But why is inflation today in 2021 hitting rates not seen for decades? Let's rewind to March 2020, when the pandemic was breaking out and the S&P 500 tumbled by over 30%. Businesses were closing, events were being cancelled, and worldwide lockdowns of uncertain duration were being triggered. This led to an economic downturn, which at the time had no clear end in sight. In response to this, the Federal Reserve in the United States and the European Central Bank in the Eurozone played their trump card, and that card was quantitative easing. Quantitative easing is used by the likes of the Fed and the ECB to inject money into the economy in order to promote and expand economic activity. They do this by buying up government and corporate bonds, among other financial assets. Trillions of dollars and euros have been printed by the Fed and the ECB over the past 20 months in order to buy up financial assets and keep the economy afloat. This buying activity will likely subside in 2022, but until then, it's expected in the US alone that we could see between $850 billion and $1 trillion worth of extra money flowing into the economy. So we've all this extra money circulating in the economy thanks to our central banks and Federal Reserves. But there's one extra ingredient to be added to our inflation cocktail: demand. Most of us spent the majority of 2020 cooped up indoors under lockdown. During that time, we weren't spending a whole pile of money. In fact, in the first quarter of 2021, Irish households saved more than €10 billion, which is 4 times greater than normal. But now, as we emerge from lockdowns and our economies start to open back up, guess what? There's tons of demand for goods and services once more. Retail sales in the US for October alone are expected to have increased by 1.5%, which is more than double September's gain of 0.7%. Now, you might be thinking to yourself that this is a good thing, which it is. It's great to see businesses get back to a degree of normality after a tough stretch. However, there's one big problem: supply. The pandemic has caused and continues to cause massive disruption to our global supply chain networks. A shortage of truck drivers has caused major issues for the UK, the US, and Germany. On top of this, you have mobility restrictions causing bottlenecks at every stage of the supply chain system. Long story short, supply is not being delivered. So what happens when we have an increase in the level of demand for goods and services in the economy without a corresponding increase in supply? That, my friends, is known as demand pull inflation. This is essentially what's happening in our global economy today. We have lots of money circulating in the economy with lots of demand for goods and services without the supply to match that demand because of the supply chain crisis. Economists describe demand pull inflation as too many dollars chasing too few goods. Because there isn't enough supply to match demand, prices increase, and the purchasing power of our idle cash sitting in the bank account falls. Housing prices are also increasing dramatically. In the first 8 months of 2021, housing prices increased by 11% in Ireland. Not only are there massive property supply shortages, but it's also becoming increasingly more expensive to build new properties in the first place. The Central Statistics Office found that the price of structural steel and reinforcing metal was up 26.7% for the year. Plaster was up almost 20%, and timber was up by over 60%. This makes building affordable housing an extremely difficult task. Not good news for a housing crisis, which we're in. With inflation being at levels not seen for decades, how are workers being protected? Inflation, which grows at a faster rate than wages and salaries, is a big problem for employees. This scenario results in a real increase in the cost of living. In Ireland's latest national budget, the government increased the minimum wage by just under 3% to account for inflation. The idea being that if you increase wages at the same rate as inflation or more, the impact of rising prices will be little to none. However, this can actually cause a feedback loop of inflation. Increasing wages results in an increase in business cost, which the business may choose to pass on to its customers through increased prices. Those increased prices results in a further increase to wages to account for the price increases, and the loop starts all over again. As well as this, inflation can actually increase demand even further, because the general population is expecting prices to be higher in the future, and so they buy now to get in at a lower cost. This demand puts additional strains on supply chains and increases prices even further. So you can start to see how inflation has the potential to get out of hand quite quickly. What the entire world is expecting the Fed and the ECB to do at some point in the future is to increase interest rates. By increasing interest rates, the inflationary pressure on the economy is reduced. That's because it becomes more expensive to borrow money, therefore reducing the amount of cash available in the economy to buy goods and services. Many economists are frustrated that interest rates haven't yet been increased, saying that the authorities are too reliant on this bout of inflation being transitory, i.e. temporary. Economists have also pointed out that the idea of inflation being transitory doesn't make a whole pile of sense, because over a long enough timeline, isn't all inflation technically transitory? This reliance on the inflation being transitory increases the risk of what's known as stagflation. Stagflation occurs where you have both rising levels of inflation as well as reductions in economic output. That reduction in economic output and growth can arise due to extended supply chain crises, similar to the ones we're seeing now. However, on the other side of the table, you also have economists saying that this inflation is transitory and there's nothing to worry about. So it really depends on who you're asking. But before the Fed and the ECB increase interest rates, or before the so-called transitory inflation goes away, what can you be doing to protect yourself? The answer is quite simple. You need to be investing as much as you can, as often as you can. And this applies not only to periods of high inflation, but as a general rule of thumb. Why do we invest our cash to protect against inflation? Well, because our investments can earn us a return that has the potential to outpace the rate of inflation. This is the minimum goal of investing, to protect the value of your initial investment insofar as possible, i.e. not taking excessive risks, and to earn an investment return that at least outpaces the rate of inflation. inflation, i.e. to protect the purchasing power of our cash. Think about it logically. If you invest your cash into a stock and the value of that stock increases by 10%, with a 5% inflation rate, your real return is going to be 5%, i.e. a 10% investment return minus 5% inflation. But if you leave your money in a bank account where it earns little to no return, your return is going to be minus 5%. i.e. the rate of inflation. That then begs the question of where you should invest your cash to protect against inflation. There's a case to be made for stocks, crypto, and real estate when it comes to deciding where you should be putting your hard-earned cash. And ultimately, the answer you get really depends on who you're talking to. My investing strategy at the moment remains pretty unchanged from 2020. I have my bedrock investments in exchange-traded funds covering the S&P 500, the European market, and the emerging markets. I then have a diverse portfolio of stocks covering the likes of technology, commodities, financial services, and aerospace. I've always been fascinated by real estate investments, and so REITs make up a significant portion of my portfolio as well. REITs, also known as real estate investment trusts, are a great investment in times of inflation, because not only do they provide you with a regular source of income in the form of dividends, but they also provide you with exposure to increases in the value of physical real estate. One of the first REIT investments I ever made was in Federal Realty, who are actually the only REIT with Dividend King status. Dividend Kings are companies who have increased their dividend payments each year for at least 50 consecutive years, and Federal Realty has done so for 54 years. You then also have Bitcoin as an option for investment to protect the purchasing power of your cash. Bitcoin is a non-inflationary token. There's a fixed amount of supply that will ever exist, and therefore the value of Bitcoin is inherently designed to resist against inflation. Compare Bitcoin to the trillions of dollars and euros printed by the Fed and the ECB to keep the economy afloat. It's that inability to make infinite supply that gives Bitcoin its mojo. Bitcoin has been called a digital gold of sorts because gold has widely been accepted as a hedge against inflation. But even gold's ability to combat against inflation reliably is questionable, with historical data showing that an increase in inflation doesn't always mean strong returns from gold. However, Bitcoin and the wider cryptocurrency market is highly volatile, making it questionable as to how effective it is as a store of value. Whatever path you choose, you need to make sure that the investment decision makes sense in the context of your own personal circumstances, your attitude and tolerance towards risk, and your short, medium, and long-term goals. Personal finance is personal, and investing is not one size fits all. What works for one person might not necessarily work for another. So based on what you've learned here today about inflation, why it's here, its effect, and its likely future, you then need to ask yourself what your next steps are and whether you want to take any action in protecting yourself against it. But the key message for you today is that investing to protect against inflation is not only required in times like these when inflation is in the news, it's required all the time. Idle cash sitting in your bank account is wasted potential, and that money could be working harder and more efficiently for your financial future. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.